The Internal Revenue Service has four specific financial moves that it will essentially pay you to make in retirement. Not metaphorically, not as a turn of phrase. The IRS has written these four strategies directly into the tax code, and when you use them correctly, the government either refunds money you already paid, exempts money you would otherwise owe, or allows you to transfer wealth completely free of federal tax. Most retirees have heard of one of them. A few have heard of two. Almost nobody is using all four. And the people who are using all four, the ones who sat down and actually ran the math, are keeping tens of thousands of dollars every single year that their neighbors are quietly handing to the government out of pure habit. I need to be direct about something before we go further, because this is the point where two groups of people tune out, and both of them lose money by doing it. The first group hears the phrase tax-free money and assumes this is some complicated scheme for wealthy people with teams of accountants. If they are living on a pension and Social Security, they figure this conversation is not for them. The second group has a comfortable retirement portfolio, but assumes the system is fixed, that they have always paid what they owed and will keep paying it, that there is nothing to be done. Both of those assumptions are wrong. Two of the four moves I am going to walk you through today are specifically most powerful for retirees with money in an IRA or investment account. The other two deliver the biggest benefit to people at every income level, including the retiree on a modest fixed income. I will tell you exactly who benefits from each one and how. My name is Carter Hale. I am an enrolled agent licensed by the federal government to represent taxpayers directly before the Internal Revenue Service. I've spent 15 years doing this work, and the single most painful thing I see in this profession is not fraud, not recklessness, not bad decisions. It is careful, intelligent people paying taxes they legally never owed because nobody ever explained the four moves I am about to walk you through. That ends today. Move number one, the qualified charitable distribution. This is the move that delivers the biggest benefit to the widest range of retirees, and it is also the one that generates the most confusion because people hear the word charitable and immediately assume it only applies to people who give large amounts to charity. That assumption is wrong, and it has cost a lot of retirees a lot of money. Here is what a qualified charitable distribution actually is. If you are 70 and a half years old or older, and you have money in a traditional IRA, you can instruct your IRA custodian to send money directly from your IRA to a qualifying charity. In 2026, you can do this for up to $111,000 per year. If you are married and both of you are 70 and a half or older, you can each do $111,000 separately for a combined maximum of $222,000. That money never appears in your taxable income. It is excluded entirely. It does not show up as income on your tax return. It does not get added to your adjusted gross income. It simply leaves your IRA and goes to the charity without ever passing through the tax system at all. Now, I want you to think carefully about what that actually means, because most people underestimate how powerful this is. If you pull money out of a traditional IRA in the normal way and then donate it to your church, two things happen. First, the withdrawal shows up as taxable income. Second, you get a charitable deduction if you itemize. But here's the problem. Since the standard deduction increased significantly, roughly 90% of retirees today take the standard deduction. They do not itemize, which means the charitable deduction they would get for donating that IRA money is worth exactly zero to them. They pulled the money out, paid income tax on it, and then donated what was left without getting any tax benefit for the donation at all. The qualified charitable distribution eliminates that entire problem. The money goes directly from your IRA to the charity. You never had the income in the first place. You pay no tax on it. You get no deduction, but you do not need a deduction because there was never any taxable income to deduct against. And here's the detail that changes the picture for people who are thinking, well, I only give a few $100s a year to my church. This probably does not apply to me. Even a small qualified charitable distribution has a cascading effect that goes far beyond the donation itself. When you reduce your adjusted gross income through a QCD, you lower the number that the entire tax system uses to calculate what you owe. Your adjusted gross income determines what percentage of your Social Security benefits are taxable. It determines whether you owe an IRMAA surcharge on your Medicare premiums. It determines your eligibility for various credits and deductions. It determines what tax bracket your other income falls into. Lowering your AGI by $20,000 through a qualified charitable distribution provides tax benefits that a $20,000 charitable deduction simply cannot replicate. The QCD does not just reduce your taxable income, it reduces the foundational number that everything else is calculated from. AOL, I had a client, a retired postal worker named Frank from outside of Cincinnati, Ohio. 74 years old. He had a traditional IRA with about $200,000 in it that he had been building since the 1980s. He gave about $1,200 a year to his church and had always written a check from his bank account and considered the matter settled. When we looked at his full picture, his adjusted gross income was putting him in the tier where 15% of his Social Security was getting taxed, and he was paying a small but real IRMAA surcharge on his Medicare premium. We redirected his annual giving through a qualified charitable distribution. $1,200 went directly from his IRA to his church. His adjusted gross income dropped. His Social Security taxation dropped to zero. His Medicare surcharge was eliminated. The total tax savings across all of those effects came to more than $2,000 in the first year. From redirecting $1,200 in giving that he was already planning to do anyway, the charity received the same amount. His IRA balance was lower by the same $1,200. The only thing that changed was that he stopped writing a check from his bank account and started doing it the right way. If you are over 70 and a half, have an IRA, and give to any charity at any amount, you should be doing this. The form to set it up takes about 10 minutes at your IRA custodian. The tax effect can be immediate and significant. The 2026 annual limit for QCDs is $111,000 per individual, or $222,000 for married couples filing jointly. The deadline to make a QCD is December 31st of the tax year for which you want it to count. No extensions are allowed beyond this date. IAFF. That is move number 1. Move number 2. The 0% capital gains bracket. This is the one that makes people say that sounds too good to be true. And I understand that reaction, because the number does sound extraordinary. But I want to walk you through the exact mechanics so you can see precisely why it is real and precisely who it applies to. Here is the fact. For 2026, a single filer with taxable income below $49,700 pays zero federal tax on long-term capital gains. A married couple with taxable income below $99,400 also pays zero. Not 15%, not 10%, zero. The federal government taxes those gains at nothing. Internal Revenue Service. Long-term capital gains are profits from selling investments you have held for more than 1 year. Stocks, mutual funds, ETFs, real estate other than your primary home. If you bought it more than 12 months ago and you sell it for more than you paid, the profit is a long-term capital gain. And if your taxable income falls below those thresholds, you pay zero federal tax on that profit. Now, the reason most people assume this does not apply to them is that they are thinking about their gross income, their total income before deductions. But the 0% threshold applies to taxable income, which is your income after all of your deductions come out. Let me show you what that looks like in practice with the actual 2026 numbers. A married couple collects $48,000 in total Social Security benefits. They also take $20,000 out of their IRA during the year. Their total gross income is $68,000. But up to 85% of Social Security can be taxable, so roughly $40,800 of their Social Security is added to their ordinary income, plus the $20,000 IRA withdrawal. That is $60,800 in ordinary income. Then they subtract their standard deduction, which in 2026 is $32,200 for a married couple filing jointly, plus the senior bonus deduction of $12,000 for 2 seniors over 65. Their taxable income comes to $16,600. They have used up $16,600 of their $99,400 0% bracket, leaving an $82,800 window wide open. That leaves a massive window wide open inside the 0% capital gains bracket. They can sell appreciated investments, stocks they have been holding for years, funds that have grown significantly, and pay zero federal tax on the gains, as long as the total capital gains do not push their taxable income above $99,400. TurboTax. This window is most powerful in the years between when you stop working and when your required minimum distributions from your IRA get large. In those years, your income is often at its lowest point in decades. Many retirees have never had a window this large to harvest investment gains tax-free, and they have no idea it exists. Smart retirees use those years deliberately, selling appreciated positions, resetting their cost basis, and removing the future tax liability from their portfolio, while the IRS is literally charging them nothing to do it. The 0% rate applies up to $98,900 for married couples filing jointly in 2026, and the 15% rate goes all the way to $613,700. That is a significant opportunity if you sell stocks, mutual funds, or property in retirement. That is move number 2. Move number 3, the Roth conversion window. This one requires a slightly longer explanation because it is a proactive move rather than a passive one, and the benefit happens over time rather than immediately on your tax return. But for retirees who have significant money in traditional IRAs or 401ks, this may be the most powerful long-term wealth preservation tool available. Here's the problem with traditional IRAs and 401ks that most people do not fully appreciate until it is too late to fix it. Every dollar you have in a traditional retirement account is pre-tax money. The government has never collected taxes on it, and the government does not intend to let you keep it that way forever. Once you reach age 73, you are required to take minimum distributions from those accounts every single year. The amount you are required to take is calculated based on your account balance and your life expectancy. As your balance grows, the required distribution grows. As you get older, the required distribution grows more. For many retirees, especially those who have been disciplined savers and have large IRA balances, the required minimum distributions that kick in at 73 push their income significantly higher than they expected. Their Social Security taxation increases. Their Medicare surcharge may appear or increase. Their taxable income jumps into a higher bracket, and they have no control over it because the government is forcing them to take that money out. A Roth conversion is the process of moving money from a traditional IRA or 401k, where it is pre-tax, into a Roth IRA, where it grows and comes out tax-free forever. You pay income tax on the amount you convert and the year you convert it. But after that, the money in your Roth IRA grows with zero tax, and when you or your heirs eventually take it out, there is no tax at all. The reason this is so powerful in retirement specifically is the window I described in move number 2. The years between when you stop working and when your required minimum distributions start can be years with unusually low taxable income. You may be in the 12% tax bracket or the 22% bracket. Those are historically low rates. Converting a portion of your traditional IRA in those low income years, paying 12 or 22% on it now, means that money will never be taxed again. Not when you take it out, not when you pass it to your children, not ever. The alternative is to leave the money in the traditional IRA, let it grow, watch the required minimum distributions force increasingly large taxable withdrawals in your 70s and 80s when you may be in a higher bracket, and ultimately have your heirs inherit the remaining balance and pay income tax on every dollar they take out, often in their peak earning years when their bracket is high. I had a client, a retired engineer named Richard from outside of Phoenix, Arizona. He was 66 years old and had just retired with $800,000 in his 401k and a pension of $24,000 a year, plus Social Security. We sat down and projected his required minimum distribution starting at 73. At current growth rates, his RMDs by age 76 were going to be over $40,000 per year. Added to his pension and Social Security, that would push him significantly into the 22% bracket and trigger an IRMAA surcharge on his Medicare. Instead, we designed a Roth conversion strategy. Each year from age 66 to 72, we converted a calculated amount, enough to fill his 12% bracket without crossing into 22%. Over those 7 years, we moved $220,000 into his Roth IRA, paying 12% on all of it. His RMDs at 73 were now significantly smaller. His Medicare premium stayed lower, and the $220,000 in his Roth IRA will grow and come out completely tax-free for the rest of his life. The math across his lifetime showed tax savings exceeding $60,000, from a strategy he could have started the day he retired if he had known about it. The window for this strategy is time-sensitive. You have the years between retirement and age 73, when your income is low and Roth conversions are cheap. Once your RMDs start, the window narrows significantly. If you are in that window right now, this conversation is urgent. That is move number 3. Move number 4, the home sale exclusion. I am including this as the 4th move because it is arguably the most valuable single tax break available to any American retiree, and a startling number of seniors who qualify for it fully do not know it exists or do not believe the numbers are real. Here is the rule. If you have lived in your home as your primary residence for at least 2 of the last 5 years, you can exclude up to $250,000 of capital gain from the sale of that home from your federal income tax if you are single. If you are married filing jointly, that exclusion doubles to $500,000. That is gain, not sale price. The gain is calculated as what you sold the home for, minus what you originally paid for it, minus the cost of any improvements you made over the years. A new kitchen, a bathroom renovation, a roof replacement, a deck addition, all of those reduce your taxable gain. Think about what that means for a couple who bought their home in 1995 for $120,000 and has watched it appreciate to $480,000. Their gain is $360,000. As a married couple, they can exclude $500,000 of gain. Their federal tax on that sale is zero, not reduced, zero. And yet I sit down with retirees regularly who are staying in homes that no longer fit their life, that are too large, too expensive to maintain, too far from their children or grandchildren, because they are terrified of the tax bill from selling. They have been sitting in a house they do not want, afraid of a tax that in most cases was never going to touch them. There are a few important things to know about this exclusion. First, the 2 of 5 year requirement. You do not have to have lived there continuously. You just need to have used the home as your primary residence for a cumulative total of 24 months within the last 5 years. This matters for people who have been spending part of the year somewhere else, like a warmer climate in winter. Second, this exclusion resets. Once you have used it, you can use it again on a different primary residence after another 2 years. It is not a one-time lifetime benefit. It is a recurring benefit tied to each primary residence. Third, if your gain is above the exclusion amount, you pay capital gains tax only on the amount above the exclusion. A single person with a gain of $350,000 would exclude $250,000 and pay long-term capital gains tax on the remaining $100,000, not on the full $350,000. And fourth, if you are also sitting on significant appreciation in that home, you may be able to combine the home sale exclusion with the 0% capital gains bracket I described in move number 2. If you are moving to a smaller place, you sell the appreciated home, exclude up to $500,000 of the gain, and if you manage your income in that year carefully, you may also pay 0% on any remaining gain above the exclusion. These 4 moves, the qualified charitable distribution, the 0% capital gains bracket, the Roth conversion window, and the home sale exclusion, are not loopholes. They are not schemes. They are provisions that Congress wrote into the tax code deliberately, intentionally, specifically because they wanted to create these incentives. The IRS is not hiding them. They are published. They are documented. They are there for anyone who knows to look. The problem is that the people who benefit from you not using them, your bank that earns on your IRA balance, the tax preparer who profits from your complexity, the government that collects when you do not claim, none of them are going to sit you down and explain these 4 moves. That is what this channel is here for. Every single one of these 4 moves requires action on your part. The QCD does not happen unless you instruct your IRA custodian to make the transfer. The 0% bracket is not applied automatically. You have to be managing your income intentionally to stay within it. The Roth conversion requires a deliberate decision and a plan. The home sale exclusion requires you to file and claim it. Being entitled to these benefits and actually capturing them are 2 completely different things. The gap between them is knowing the rules and taking action. Do one thing for me before you close this video. Look at each of the 4 moves and identify which one applies most directly to your situation right now. Are you over 70 and a half with an IRA and a charitable habit? That is the QCD. Are you in a low-income year between retirement and your required minimum distributions? That is the 0% bracket and the Roth conversion window. Are you thinking about selling a home you have lived in for years? That is the home sale exclusion. Pick the one that fits and start there. Then send this video to one person in your life who is in retirement or approaching it, because the odds are very good that at least one of these 4 moves applies to their situation right now, and nobody has ever explained it to them. I will see you in the next one.